Good morning, ladies and gentlemen. You are welcome to today's session, this webinar on the controller advantage, building a reliable financial reporting framework through ICoFR. Wherever you are, if you can hear me, kindly react with a thumbs up. And from whichever sector that you are from, you can drop that sector within the chat box as well, just to get it very interactive from the start. We have two pivotal things that we are handling for today. We are going to be dealing with representation, and then also we'll be going through a panel discussion with some very seasoned panelists that we have on the call with us today. For years, we have witnessed the sudden collapse of organizations that once appeared quite resilient, agile, and successful. In many cases, the underlying cause can be traced to weaknesses in internal controls that went unnoticed or unaddressed. As financial information continues to drive critical business decisions, it is worth asking, how much does the quality and accuracy of financial data, from initial capture and processing to final reporting, influence the reliability of your organization's financial reporting framework? And this is where the control advantage comes to play. Some of you may have heard the term ICoFR before. You may have heard ICFR before. There are others as well on this call that do not know what ICoFR is. And to give us a groundbreaking understanding of what ICoFR is, we have two of our panelists that will be handling that for us in the presence of Priscilla Piazza and Frank Appiah-Agyeman. Before they come on, I want us to observe some few house rules. And that is that you should be open and receptive to the discussion that is going on. If you have your pen and paper by you, your notebook, take some notes down, reflect on the learnings that we are about to get for today, and then also seek clarity when needed through the chat box. So if you have any questions that you want to drop in the chat box, it's open at the appropriate time during the live Q&A session. We are going to take those questions and then answer them through our panelists that we have for us today. Before we proceed, I would like us to get a brief profile of these two individuals that will be taking us through the anchor presentation for us. Priscilla is a manager with the Governance, Risk and Compliance Services unit within KPMG Ghana. She's a member of the Institute of Chartered Accountants Ghana. She has over 10 years of professional experience, comprising more than 4 years in external auditing and over 6 years in advisory services. Priscilla supports clients in strengthening their governance, risk management, and internal control environments by assessing and enhancing internal controls, internal audit functions, and enterprise risk management frameworks. She has participated in and led numerous engagements focused on reviewing financial statements, evaluating internal control systems, and assessing risk management processes. Priscilla has extensive experience serving clients across a variety of industries, including banking, energy and natural resources, manufacturing, mining, and construction. As an engagement manager on several engagements, Priscilla has assisted organizations in identifying key risks and implementing practical solutions to improve operational effectiveness and governance practices. Next on the bill for us today, we have Frank, who will be assisting with the same presentation as well. Frank is an assistant manager with the Governance, Risk and Compliance Services unit in KPMG Ghana. He holds a bachelor's degree in administration, that's an accounting option, from the University of Ghana Business School. He's a chartered accountant with the ICAG, that's the Institute of Chartered Accountants Ghana, and is also a certified information systems auditor. He has over 6 years of experience delivering governance, risk management, and compliance advisory services. He has supported clients across multiple sectors, including financial services, consumer and industrial markets, energy and natural resources, telecommunication, and the public sector. He has extensive experience helping organizations identify, assess, and manage risks while strengthening governance and compliance frameworks. His work spans enterprise risk management, regulatory compliance, governance assessments, internal control of financial reporting reviews, internal audits, and control evaluations, contributing to stronger control environments and risk governance practices for the clients that he has served. And with a virtual clap, let's invite Frank and then Priscilla. Frank and Priscilla, please, you have the floor. Thank you.
All right, thank you, Prince, and good morning, everyone. It's a pleasure to have you join us for today's conversation on internal controls over financial reporting or ICoFR. And as we get into the discussion, I recognize that we will have different levels of familiarity with ICoFR on the call today. For some of you, you may already have ICoFR in place within your organizations, and for others, this may be your first introduction to the concept. So we'll start by building an understanding of what ICoFR is and how it works. And from there, we will look at how ICoFR has developed across different markets before bringing a conversation home to Ghana and what it means for organizations here.
Yes.
So to get us started, let's look at these two organizations. We have organization A and B. And from a glance, both are growing and profitable. But I want to ask a question. If you had the opportunity to invest in one of them today, which one would you choose? And I'll be expecting answers in the chat box. If you had the opportunity to invest in one of them today, which one would you choose? I'm not seeing the responses. So looking at organization two from a glance, if you had the opportunity to invest in one of them today, which one would you choose? All right. So I can see uh, some A's coming in, and I can't see any B in the chat box. But I want to ask a question first. In making our decision, do we think the numbers we have here provide sufficient evidence for us to reach a confident conclusion? Because even though the numbers give us a sense of how each organization is performing, we would also want to know how much confidence we can place in those numbers. And to have that confidence, we need to understand what sits behind the numbers. Are the right processes and controls in place? Are they working effectively? And if something goes wrong, would it be identified before it affects the financial information being reported? Because those processes and controls are what produce the numbers you see. And if they are not working as they should, that can affect the reliability of the information we are using to make our decision. So if organizations want their information to be reliable, they need a way to identify what could go wrong, put the right controls in place, and know whether those controls are actually working. And that is what ICoFR is designed to do. Now, the concern we have just talked about around being able to rely on financial information is not a new one. Over the years, there have been a number of events or situations where organizations appear to be performing well from the outside, but problems were developing behind the scenes, and Aaron was one of the biggest cases at the time. And in Aaron's case, investors were relying on financial information that made the company look much stronger or look like they were performing well, as we saw in organization A and B, than it actually was. And when the true position came out, the company collapsed and investors lost billions of dollars. And then you realize that Aaron wasn't the only case. Other corporate failures around the same period were also raising concerns about financial reporting, internal controls, and the level of accountability within the organizations. And as these concerns continue to emerge across different organizations, the focus tends to accountability for financial reporting and the control supporting it. And in the US, that led to the introduction of the 𝗧𝗵𝗃 Act in 2002, which placed greater accountability on management, not only for the financial information being reported, but also for the control supporting that reporting. And since then, other events have continued to reinforce the importance of ICoFR. We saw this during the global financial crisis. We have seen it in developments here in Ghana, and more recent corporate failures have continued to show why ICoFR remains relevant today. Now, the textbook definition of internal control and financial reporting states that they are the procedures and processes put in place by an organization to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements in accordance with applicable accounting standards. And what that means in practice is having the right controls in place across the activities, processes, and systems involved in producing financial information so that the information being reported can be relied on. And to bring those controls together, the ICoFR adopts the COSO internal control integrated framework, which looks at internal control across 5 components, starting with the control environment, which is about oversight, accountability, and the importance management placed on internal control. And from there, risk assessment looks at the risks that could affect financial reporting, and control activities are the controls put in place to address those risks. And then information and communication is about getting the right information to the right people. And the last component is monitoring, which looks at whether the controls continue to work and whether issues are being addressed. So these 5 components provide a foundation for internal control within ICoFR. And within the ICoFR framework, you have different categories of controls operating across the organization, which are the entity level controls, such as organization-wide policies, the process level controls, which operate within specific business processes. And because many of those processes rely on technology, you also have IT controls supporting the systems using financial reporting. And we have fraud controls that address the risks of deliberate misstatements. So when we talk about ICoFR, we are talking about all of these elements working together to support reliable financial reporting. We have put together 6 steps to show what implementing ICoFR looks like in practice. So starting with step 1, that is setting the tone at the top, which starts with the board and management, with the board providing oversight, management driving ICoFR, and that flowing through to the people who are responsible for the controls day to day. Then from there, step 2 is establishing materiality. And this is important because ICoFR takes a risk-based approach, which means you are not looking at every number in the financial statement in the same level of detail. So materiality helps you determine what is significant. And that takes us to step 3, where we use that materiality to determine which financial statement line items, or what we call FSLIs, come into scope. And by FSLIs, we mean the accounts and disclosures in the financial statements, such as revenue, inventory, or PP. So once we know what is in scope, step 4 takes us into the processes that produce those numbers. So if revenue is in scope, for example, we look at what happens from when a sale is made through how it is processed and recorded until it is reported as revenue in the financial statement. And as we go through that process, we identify what could go wrong and the controls in place to prevent or detect it. And in step 5, we look at whether the controls in place address the risks we have identified. And where there is a gap, we either strengthen the existing control or put a control in place to address that risk, including controls within the systems that support financial reporting. And once the controls are in place to address those risks, step 6 is about checking whether they continue to work as expected, with any issues identified, addressed, and followed up. And as the organization changes, whether through changes in processes, systems, or financial reporting risks, the controls also need to change with it. And throughout that journey, KPMG can support organizations from implementation through to testing and remediation. So at this point, I'll hand over to Priscilla, who will take us through the ICoFR regulatory landscape. So Priscilla.
Thank you, Frank. I think Frank has done a good job trying to set the context to help us understand what ICoFR is and how it can be implemented. What I'll try to do is try and situate it into today's world, that's in Ghana. What does that look like from a regulatory standpoint and even for entities as a whole? Now, before I speak about Ghana, because I'm sure everybody's interested to know what is happening in Ghana when it comes to ICoFR, I would want to focus a bit more on other jurisdictions. I think Frank mentioned the Sarbanes-Oxley Act in America, and then we also have Canada, and then Nigeria. So I'll speak briefly on what's happening in those spaces when it comes to ICoFR, and then we'll bring it home to Ghana. So regulators have responded quite similarly in these 3 jurisdictions when it comes to ICoFR. major of the regulatory developments around ICoFR were triggered by large corporate failures, like Frank mentioned on Enron, and financial reporting scandals. There were huge scandals that really affected a lot of industries and investors. And so for that reason, regulators thought it wise to institute this additional layer of protection to boost investor confidence and also to safeguard assets. So these are some of the regulatory interventions that were made in these jurisdictions. Now, regulators have also realized increasingly how reliable financial reporting issues are. And that is why they have instituted ICoFR to make sure that the numbers have the right foundation in terms of their reliability. Now, so what we are talking about is formal requirements around management accountability, and then also internal control assessment and also external assurance. So let's talk about Nigeria. Okay, maybe I'll start with the US. So we have the Sarbanes-Oxley Act in the US that was instituted somewhere in the 2000s because of the Enron case and a few other cases where the CEO and the CFO are mandated to self-certify. So here, what it means is that they would have to disclose in their financial statements that, yes, indeed, we've looked at our environment, we've looked at our controls, and we can tell you with confidence that our controls are working effectively. So that is one of the disclosures or formal requirements that are required in the US when it comes to ICoFR. Now, in Canada, is a similar approach through the National Instrument 52109, where CEOs and CFOs are also supposed to do a self-certification and also disclose any material weaknesses in their financial statements. Now, bringing it home to West Africa, Nigeria also hopped onto this train in 2023, where they introduced requirements for public interest entities and listed entities to establish, assess, and report on the effectiveness on ICoFR. So this is something that is really big in Nigeria, in the UK, in Canada, and also in the US. Now, it is very clear the focus has now shifted from just financial reporting to demonstrating how organizations should ensure their reliability. So now the focus is, yes, you've produced the numbers, but what is the evidence that the process that went through churning out the numbers was reliable? That is what this conversation is all about. Now let's bring it home to Ghana. So maybe Prince, you can move on to the next slide. Where does Ghana sit in all of this? Now, currently, ICoFR is not a regulatory requirement in Ghana, but there are conversations around this that are happening in the background, and that is why this conversation has become very important to have. Now, you even realize that there are triggers. So if you look at the Bank of Ghana Corporate Directive, the 2022 Corporate Governance Directive, realize that the BOG has said that for the board, they are supposed to also disclose the status of internal controls over financial reporting, the audited financials. I believe it's section 14(1)(c) that talks about that. Now, the Companies Act also places some responsibility on directors for maintaining proper accounting records and overseeing financial reporting. So you see that the Companies Act also speaks about it. Now, within the public sector, the PFM Act also talks about strengthening requirements around internal controls, risk management, and also internal auditing. Even for SEC, listed entities are also required to provide some governance disclosures under the SEC Corporate Governance Code. So you realize that in all of these regulations, there are some indications here and there as to why ICoFR is important. But what we are saying is that while these regulations or these directives are good and it's a solid foundation, there's quite an opportunity for us to strengthen consistency and accountability by making this a formal requirement. Now, there are quite some number of opportunities for ICoFR, especially in Ghana. Now, what would that look like? First of all, we'd have something called a management certification. I called it a self-certification, where is the sole responsibility of the CEO or the CFO to disclose the status of internal controls over financial reporting as part of their disclosures in their financial reports. So yes, they would say, yes, I did the work myself. I am confident that the controls surrounding the numbers that I've published are fine. Now, what that looks like for us is also a recognized ICoFR framework. So in Ghana, what it would look like is that we'll have a standardized framework for ICoFR. So whether it's the banking industry, whether it's the insurance, whether it's pensions, there's a standardized framework across all sectors of the country. Now, what that looks like again is to have external auditors. So usually when this framework is instituted, you'd have external auditors to do something called an attestation. So here, as part of their procedures, when they come for their statutory audits, they look at the information or the evidence to support what the CEO or the CFO is saying, and then they'll have to give an opinion. So that is called an attestation. So they attest to what the CFO or the CEO is saying. If we do all of this, what it means is that we'll have a more harmonized and consolidated regulatory approach across all industries. So having the PFM Act, having the BOG Directive, having SEC, all of these things will come together for a more harmonized, consolidated, and standardized approach to ICoFR. Now, like I said, this is a conversation that is happening in the background, and that is why this conversation has become even more important to have. The good news is that for Ghana, we are not starting from zero. The building blocks are already there. All we need to do is just bring it together for a more structured ICoFR framework. Prince, if you can move on to the next slide. The next conversation will be about how entities can approach ICoFR as a regulation. Prince. Yes. So if it becomes a regulatory requirement, there are two ways an entity can approach this, from the compliance approach or from the value approach. Now, one thing that I find quite interesting about ICoFR is the fact that even though it's a regulatory requirement, there are tremendous benefits an organization seeks to benefit when they institutionalize. It's more of a business resilience and a corporate governance initiative. So outside of what the regulator is saying, it significantly or positively affects your business as a whole. So let's forget about compliance. How is it even impacting your business? That's what this conversation is about. Now imagine an entity decides to go the compliance route, right? Where they are only focused on meeting a particular requirement. What it means is that they will just build something to satisfy the regulator or to just tick a checkbox. And they don't really see the value. You don't really see how it practically adds value to the organization. Now, what that means is that there will be a file. I'm sure there'll be like a case file put down for when auditors come to show them. But you realize that we're not really involved management. So people don't really understand what is happening in the ICoFR space. So it's only about putting or maintaining some documentation for auditors to come and check. So then how do we make it a cultural shift if people are not aware, employees are not aware, management is not aware? Well, management would be aware, but a chunk of people in the organization wouldn't have an idea what it is. Just a few people that will put it together just to tick a box. Now, the value approach, on the other hand, I believe is a better approach where you'd have stronger financial reporting, where financial reports would have reduced risk of misstatements and errors, because now you're looking at it from a value standpoint. You see the essence of having this framework as part of the organization. So you'll be able to build better structures to ensure reliable financial reporting. Now, one good thing about ICoFR, especially for the clients that I have engaged with, is more on efficient audits and then reduction of audit fatigue. Because I'm sure for a number of our clients or even people in the industry, they are tired of auditors. They see auditors every day and they feel like it's just too much. Today, GRA is coming. Tomorrow it is BOG. Today it's KPMG. I'm sure everybody is tired. So with this one, what happens is that we collaborate with external auditors, okay, where we make sure we align on some key risk assessment indicators. So when it comes to your materiality benchmarks, those are things that we align on. And when that happens and there's that collaborative effort, the external auditors can now rely on the work that we have done or the documentation that we have done. And what that means is that there'll be faster audits, it will be more seamless, and it will be more timely. So it's a very, very good benefit when this is implemented. Now, at the end of the day, one of the key things ICoFR seeks to do is also fraud prevention. Yes, I know fraud to an extent is about collusion. So if you have two or more, three people coming together to perpetrate the fraud, it can be difficult to detect. But at least at the baseline, you have some very strong or robust controls to ensure that fraud is brought to the barest minimum. Now, it also supports with a proactive approach towards risk. So instead of waiting for the risks to fully materialize and respond, you're able to have a proactive approach where you can early detect it. So before it even becomes a big thing, you've quickly picked it up and then you've remediated. So it's very important. Now, all of this, I think Frank has mentioned it, but I'll mention it again. We've seen that for most entities, yes, they have financial reports. Yes, they publish it. Yes, we have external auditors. But yes, though, we are seeing all of these crises where entities are crashing, businesses are collapsing. Why is this so? This is going to give you an added layer of protection where investors feel like, yes, I can rely on the numbers that are being published, because outside of what I'm seeing, the right structures have been put in place. We've gone through a rigorous process in ensuring that the numbers that I'm looking at have the right controls to support them. So that is where investor confidence becomes a key attribute of this ICoFR. Now, you do all of this where you are boosting investor confidence, you are having a better approach towards your risk, your audits are more efficient, you have better financial reporting processes, and then the regulator comes and says, I want to see what you've done on that, and you are ready. You have all these benefits for your business, and you're also regulatory ready. That is why the value approach is more important. For compliance, people don't really see the value in it, and so they just do something just to satisfy a checkbox, missing out on all the other tremendous benefits they can get from this ICoFR implementation. Okay, Prince, maybe we'll move on to the next slide. What I'll try to do is summarize everything that we said, and then we'll go into the panel discussion. So maybe 5 key points I would leave with you. First is that the numbers alone cannot tell the story. From the illustration Frank gave us from A and B, realize that just looking at the numbers alone couldn't tell us, yes, we might see a company that is profitable, but is it really the numbers as they are? Is it an accurate reflection of how well the company is doing? That we don't know. So what ICoFR tends to do is, once you have those structures in place and you're able to add that to your disclosure requirement, we know that, yes, as outside of just seeing that you are doing well, we know that it is the right thing you are presenting because the controls behind them are working well. So the numbers alone don't tell the story. That is why ICoFR is important. Now, it also makes your financial reporting framework or system more reliable and more seamless. So you make sure that we cut out inefficiencies. Where there are risks, we are able to address them and mitigate them. And of course, at the end of the day, your financial reports are more reliable. Now, unfortunately, Ghana is late to the game because Nigeria is already doing it. US is doing it, Canada, UK, all these other matured industries are doing this. So it's a wake-up call for us to just put this in place and make sure that we are safeguarding our assets as a whole. Now, one key thing I want us to look at this from is from the fact that it is not just about risk. There's a lot of opportunity for growth. There's an opportunity for better business reliance. There's an opportunity for corporate governance initiatives. There's an opportunity for us to better reach our organizational objectives by instituting this. Now, I know that for a number of the webinars that we have, we talk, and go. Today, we are not doing that. What we are doing is, outside of just having the conversation, we want to also act on it. So after having this meeting, I'm expecting that most people in their organizations will start having meetings to really see how best they can address this, really see how best they can approach this ICoFR thing, because it's a very, very big movement happening. Now, and maybe I'll touch on what it will look like for regulators and policymakers if they are going to do this. Now, they can consider what we already have through our PFM Act, through the BOG directive, and try and bring it home and make it standardized. And then, of course, we also want to meet international expectations. So how to bring this and streamline this into a standardized approach that makes it more formal and regulated. Now, of course, SEC Nigeria is doing something on this already. I know that there's an MOU with SEC Ghana. You can leverage on that MOU to understand how SEC Nigeria and then of course the FRCN, which is also an equivalent of ICAG in Ghana, how they came about to implement this. We can draw on those experiences and then see how best we can make the regulation ready. Now, we can use a phased approach because I'm sure that some entities are not ready for this. So we can target the listed and public interest entities like Nigeria has been doing, and then gradually trickle it down to the other industries. Now, we don't do this alone. You also want to engage industry stakeholders to ensure that you are bringing them on board, you are collaborating with them, and you are picking their thoughts on some of these interventions. So in summary, this is what ICoFR is all about. I would hand over to the moderator to take us through the rest of the session. Thank you so much.
Thank you very much for that, Priscilla and then Frank. It's been a very insightful session. For those of us that joined us earlier on the call, as I stated, we have 4 seasoned panelists with us on the call. We've had the introduction of the first 2. And we are moving on to the additional 2 that will be joining us for the panel discussion. And the next person that we have on the bill to speak to us today is Jeremiah Nwosu. And he is a manager with the Internal Audit Governance Risk Compliance Services practice in KPMG Nigeria, with over 8 years of experience supporting organizations in strengthening governance, enterprise risk management, internal controls, and assurance functions across multiple industries. He has led the design and implementation of internal control of financial reporting frameworks for clients in the telecommunication, oil and gas, financial services, and consumer and industrial market sectors. He has also facilitated risk management, internal controls, and ICoFR capability building programs for assurance professionals, boards, and senior management teams. Jeremiah has strong expertise in technology-enabled assurance, including the development and implementation of automation solutions for continuous auditing and continuous monitoring. He is also experienced in the assessment of information technology general controls and information technology application controls across various sectors. Jeremiah holds a first-class honors degree in industrial chemistry in Nigeria, an MBA, and a master's degree in financial engineering from the United States. He's a certified information systems auditor and a member of the Institute of Internal Auditors. You are welcome to today's discussion, Jeremiah. If you can hear me, kindly confirm.
Yes, I can hear you. Thank you.
Thank you very much. Thank you for that. Yes, and last but not least, we have our industry expert from the banking sector. He's in the person of Hadi Ali, and he is the head of internal control for Zenith Bank Ghana Limited, with a banking experience spanning over 19 years in the field of banking operations, audit and internal controls, credit review and analysis, and conducting investigations into cases of fraud, operational lapses, and breaches. Prior to being appointed as the head of internal control, Hadi held several positions within the bank, where he served at various times as a board administrator, the head of credit review and monitoring unit, the head of branch supervision, and head investigation and head office corporate audit unit. Hadi has received various commendations and awards in the line of duty. He started his career as a direct sales agent with Ecobank Ghana Limited. Hadi holds a Bachelor of Commerce degree, accounting option from the University of Cape Coast, and is an affiliate member of the Institute of Chartered Accountants Ghana. He is also a PECB certified ISO 22301 lead auditor. Hadi is an advocate of adherence to the regulatory directives and compliance with internal control policies. That brings us to the end for our panel members that we have for today. So to our panel, if you cannot hear me, kindly confirm so that we can proceed. We've had the presentation on what ICoFR is and how the landscape of Ghana is looking as at now. But to set the ball rolling, we will have Jeremiah take us through a bit of how the scene in Nigeria looks like as at now. Jeremiah, please, can you hear me?
Yes, thank you, Prince, and thank you, Frank and Prisca, for the presentation. It was quite insightful. So as to what the scene looks like in Nigeria, I think Frank had mentioned that initially we had the requirement for publicly listed entities based on sex regulation around 2022 and 2023. And we also had a mention also of the requirement in the FRCN's guideline, but it wasn't clear. So in 2023, what had happened was the FRCN actually clarified the requirement and expanded the scope of entities that had to comply with the attestation to the effectiveness of ICFR. And what that meant was there was a definition of publicly listed entities, high revenue entities that had to then disclose on the effectiveness of their internal control over financial reporting. And since then, we've had that in motion for over 3 years. Several organizations, whether the bank, oil and gas, who meet those requirements, implementing ICFR within their organization. And I will tell you that there's been a lot of in implementing ICFR over internal control over financial reporting. There's typically a lot of documentation, as we all may know, and it's a phased approach that you would have organizations adopt because, for instance, you need to first identify the material account. In identifying those material accounts, you need to also map that to information systems. You need to engage a lot of stakeholders. So in doing that, you need that leadership. You need the commitment of senior management to be able to galvanize, because you have several touch points within the business, and that's what we find. We find that we're having to pull in a lot of stakeholders. You need to be aware of where a control point sits, or where you're supposed to get that information from. And this requirement specified 3 major stakeholders. One is the board. The other is senior management, including the CEO and the CFO, and lastly, the external auditors. What that implies is that first, the board needs to establish the system of internal control and then ensure that they are functioning. It means that you need to get that information maybe from internal audit, from internal control, to be able to, have a reasonable assurance reasonable assurance on the functioning of your internal control over financial reporting. But beyond that, you don't have the regulation requiring that management should attest annually to the effectiveness of internal control over financial reporting. We've had situations where management have refused to attest, except there's an independent review of internal control over financial reporting, largely because of the size of the organization, operation across different jurisdictions. Then beyond that, you would also have to evidence to your external auditors that your internal control over financial reporting is functioning, because they have to issue an independent report on those controls, on your system of controls. So you see, there are a lot of moving points and a lot of stakeholders that you need to satisfy before disclosing within your financial statement, and also to the Financial Reporting Council of Nigeria. So that's the current state, and it has been in motion for about 3 years now for publicly listed PIs, that's public interest entities. But ICFR is not new in Nigeria. We've had publicly listed entities performing ICFR for a while, and we also have for entities that probably operate outside Nigeria. You have this requirement in the UK, you have this requirement in the US. So it's a trend that is growing. We're seeing, for instance, in the UK, there's a provision 29 in the amended UK Code of Corporate Governance that even goes beyond financial controls to say all controls, including operational, financial compliance controls, and prescribes a requirement for the board to establish and monitor controls over material accounts, and also disclose where there are material deficiencies, material weaknesses.
Okay, thank you for that submission. That's a very good understanding of the current landscape around ICoFR in Nigeria? And based on what you have observed around what you just submitted, has the regulation genuinely strengthened the control environment, or has it just improved the quality of documentation and the reporting?
Thank you for that question, friends. I think it has done both, based on my experience, because first I had mentioned the various stakeholders. Definitely you need sufficient documentation. You need to document those controls. You need to map them to relevant business processes, stakeholders. You need to identify IT controls. But beyond documentation, you need to then communicate, whether to the board, how you're testing those controls periodically, and where there are material weaknesses or significant deficiencies. You'd also have to have clear action plan for remediation. Now, an example is an organization that's, let's say, into energy generation or distribution. You have a billing system, and then you have an ERP. If there's a disconnect between your billing system and your ERP, your data, your revenue data would be false, and that would mean that your revenue could be understated or overstated within your financial report. If that's identified early enough during your internal control or during ICFR implementation, typically there'll be a management action plan to remediate that. Otherwise, you'd have to disclose that to your investors, to your creditors, to regulators. And organizations don't want to do things like that. So it means that they would proactively remediate that. So first, it gives you confidence as an investor or a creditor when you see these disclosures or this attestation to the effectiveness of internal control over financial reporting. Then secondly, as senior management, you have confidence in the data, financial data you use for decision making within your business. So most forward-looking organizations are actually using the ICFR as an opportunity to strengthen their control environment such that they have confidence in their financial data and they have confidence in the information that they share with external stakeholders. So if I would summarize, yes, it requires a lot of documentation that's improved the quality of evidential matter provided to the assurance function, particularly the external auditors. But beyond that, because of the requirements and all of the stakeholders involved, you've had to have a lot of transformation happen within organizations to be able to meet the requirement. Thank you.
Okay, thank you for that, Jeremiah. That's a very insightful one. So it's not a singular one, but then it's something that has been benefiting to the companies that are in Nigeria at both fronts, and that is well acknowledged. Piggybacking off that same regulatory perspective in Nigeria, for Hadi, if you can hear me, yes. So we know that Zenith Bank PLC in Nigeria has some requirements that they have to meet with regard to ICFR or ICoFR within this jurisdiction. And as one of the subsidiaries of Zenith Bank PLC, you had to kickstart your ICoFR journey quite early and become a bit of a when it comes to ICoFR in Ghana. Within the span of time that you have dealt with this ICoFR process, have you seen any changes in the quality of financial reporting, accountability, and governance within the whole structure, the ICFR framework for Zenith Bank Ghana Limited? Hadi?
Oh, thank you very much, Prince, for that question. I think before I proceed to respond to your question, let me first and foremost say a very good morning to my fellow panelists and our participants who have join the call today. And also to us, it will commend KPMG for spearheading and taking a leadership role in raising awareness and throwing more light on the importance of ICoFR. And in the process, helping to strengthen the internal control systems across our financial ecosystem. Now, with respect to your question on the changes we have witnessed in terms of the quality of financial reporting since implementing, ICoFR, I will say that it has greatly enhanced the accuracy of our financial statement. Why? Because, processes have been standardized in the course of ICoFR implementation, and controls have been duly validated just to ensure that they are actually working as expected in terms of their ability to prevent and detect material misstatements. And then in terms of accountability, it has actually encouraged supervisors to, as it were, take responsibility for the effectiveness of controls within their departments, knowing that they are the first line of control and also risk owners as well. And then corporate governance wise, yes, it has enhanced our risk management framework because financial control has become part of our enterprise risk management more than ever before. And then again, there is a stronger board oversight because it has improved the quality of information received by the board and the audit committee in terms of the coverage. Thank you.
Thank you so much for that response, Hadi. Yes, for the panelists that I have on the call, yes, we've seen that for many CEOs and then board members, they still see ICFR as a finance or compliance initiative, not something that they are supposed to be spearheading. From your experience, what is the business case that resonates most with boards? And how should directors, how should they view their oversight responsibilities when it comes to ICoFR? This is to all my panel members. Anybody can take the question.
Okay, so I think I'll start. I'm sure Jeremiah, Frank, and maybe Hadi would have some inputs to add. Now, from my experience engaging with board members, realize that usually when ICoFR is framed as a business reliance or business resilience, sorry, and the governance and the governance issue rather than just the compliance issue, realize that they become more interested and they care more. Okay, so it's more than just meeting the regulatory requirements, but the fact that it will support business resilience and it's like a good corporate governance initiative to have. When you frame it that way, they seem to be more curious and want to understand what it is about. Now, the reality is that the board do not make decisions based on controls. Let's just be honest. They make decisions based on information. But imagine that the information they're making decisions on are inaccurate or incomplete or delayed. Then how, even if they have very good strategic decisions or ideas, they can easily be compromised because the information with which they're making those decisions are probably false or inaccurate. So they can't make very informed decisions because the information that they are relying on to make a judgment is flawed. Now, for me, the business case that I would present to any board is that confidence in decision-making is one of the key things ICoFR supports with. And of course, it also protects the enterprise value. So that is my take on it. Thank you.
Thank you for that, Priscilla. To our other panelists, you can have a go at it as well.
Thank you. I think I would just. Okay, Hadi.
Okay, so I think we'll take Jeremiah and then Hadi will come in, and if Frank has something, he can also drop it. Thank you.
All right, thank you very much. So, for me, to be honest, I don't even like to make a distinction between compliance and value addition, because in some clients you find out that complying preserves value for the organization, particularly where you have a Pan-Africa or a global a brand that's your vision is to become global. You see how when you implement ICFR, you're ready for any jurisdiction you're entering to be able to comply with regulations. So in making those decisions, if you already have this in place, the board management, they are already confident that they have the right framework to be able, like the best practice, to be able to function across clients. That's one. And as 𝗕𝗂𝗃 has said, definitely once you're sure about the processes and the systems through which you generate data or operate, then decision making is easier and you have more confidence in that in this. But then beyond that, in terms of key strategic decision, expansion decisions, credit decisions that stakeholders would make, investors' decision, once you have a framework in place that gives them that confidence, then it's easy to do business. An example I would give is we typically have something similar for IT system providers, your Google, your Oracle, and the likes, and even some organizations that probably export managed services, IT managed services to other clients. You have the SOC 1 and SOC 2 requirement. So think about your ICFR like that requirement, where you're going to someone that you want to partner with, a business you want to partner with, and say, I have this attestation to our internal controller financial that they are functioning and you can rely on our business. So when you frame it like that, then those in charge with governance, those who make critical decisions within the business, see ICFR beyond compliance as a strategic value add.
Thank you for that submission. That is well noted. Yes, Hadi, please, you have the floor.
All right, I think just to add to what Jeff and then 𝗕𝗂𝗃 have indicated, we all know that the oversight responsibility of controls lies with the board. So if for any other reason there is a particular framework that can more of widen the scope of that access to that information, then I think ICoFR comes ready. So it gives that assurance with respect to the kind of controls that have been used to prepare the financial statement. That is where ICoFR stands very, very, very tall.
Thank you for that. Yes, I think Frank will have the last go at it, and then we'll move on to the next session.
All right, so I'd like to add my voice to it. So I think what resonates most with boards is being able to trust the financial information in front of them, because the directors use those numbers to understand how the organization is performing, and for them to rely on those numbers, they also need confidence in the controls behind how the numbers are produced, which is where ICoFR comes in by helping them to make sure the right controls are in place and working. So it should not be seen simply as something for finance or compliance, but as something that supports the board in doing this job. And that means directors do not need to perform the controls themselves, but they should be asking whether there are issues that could affect the financial information they receive, what management is doing about those issues, and then whether the same problems keep coming back. So that's my take.
Okay, thank you so much for that. So at least we are having some submissions from the team, and what we are getting a sense of is that ICoFR is not just a finance or compliance initiative, but then it's going beyond that to a value addition activity for the board in general, not just for the finance or compliance part of what ICoFR is meant to achieve. Yes, following up from that, 𝗕𝗂𝗃, based on your experience working with boards in Ghana, what questions are directors currently asking about internal controls? Are they becoming more interested in control effectiveness, or is this decision around whether to have an ICFR framework in place still based largely on compliance, even though we have segmented ways of being compliant based on the presentation that you did with Frank to us? Thank you.
Okay, thank you. I think it will be interesting to know that many boards are taking a more risk-based approach in trying to seek assurance or some sort of comfort over internal controls, because they are more forward-looking and they're trying to protect the organization and also seek some sustainable growth. So you realize that there are questions around fraud risk, because they have realized that fraud issues can become scandals. They can lead to the collapse of organizations. So now more questions or curiosities are around fraud-related issues. Right now we are in the era of AI. So issues around cybersecurity, automation, data integrity, and of course, the compliance bit is still something that they care about. But then I think it goes beyond that. Some of the questions they might ask are emerging risks from digital transformations or ERP implementation, because now most businesses are moving from the manual way of doing things into automation. So if you are going to implement an ERP system, what are some of the risks that come or are associated with ERP implementation, and how are we even controlling them? How are we being preemptive to see what risks come with such ERP implementation and what we can do to make sure that we have the right controls or measures in place to address those risks? So those are some of the thought-provoking questions they ask. Now, they are focused on key business risk because there are some key processes that drive the success of the organization. So they are more focused on questions around key business risk. So areas around financial, operational, and technology risk. So some key business functions such as revenue process, your PPE process, your cost of sales, of course, depending on the nature of the industry that we are dealing with. Those are some of the key areas that they want to ask questions or try and understand the risk that drive those processes and also get the right controls to mitigate the risk. Now, while compliance remains important, many boards are still shifting their focus on control effectiveness and risk management, particularly in the highly regulated sectors, the banking and then the insurance spaces. You realize that the boards are being more proactive to try and get ahead of regulation and try and really drive value for the organization. Thank you.
Thank you for that. So the boards are moving from the compliance perspective to a value-based and a first mover advantage sort of look, because if it becomes regulatory in some years to come here in Ghana, they would want to have that first move on that. That's well noted. Frank, do you have anything for us?
Okay, great. So I'd just like to corroborate what Professor just said. I would say boards are becoming more interested in whether controls are working, and you can see it. You can see that from the questions directors are asking, because they want to know whether the right controls are in place, whether they are working, where the issues are, and what management is doing about them. And when the same issues keep coming back, they also want to understand why and what that means for the organization. So compliance is so important to them, just as Priscilla mentioned, but boards are also looking beyond that and asking whether the control environment is doing what it's supposed to do.
Okay, thank you for that submission, Frank. For Priscilla, again, delving deeper on what you spoke about currently for Ghana, we do not have any consolidated mandatory ICoFR reporting framework. But then we have sector-specific regulations. We made mention of the Bank of Ghana Disclosure Directive, having some sections of it dealing with some level of control effectiveness, and that role being assigned to certain people within the framework of an organization. Where do you see the biggest gaps today when it comes to Ghana's setting, and what should organizations be doing to strengthen their control environment ahead of any future regulatory developments that we might have within Ghana?
Okay. So I would say that the biggest gap I have identified is the lack of a standardized ICoFR framework. So when you engage in a number of entities, you realize that they have bits and pieces of ICoFR in their processes. They have risk and control matrix. I don't know if Frank mentioned that we have a risk and control matrix document. That is basically a document that is used to document end-to-end key business processes, the inherent risk, the controls, and some monitoring activities. So you realize that they will have bits and pieces of them here and there, but it's not a really standardized framework for you to be able to follow through from the tone at the top or evaluate all the 𝗂𝗏 principles across. Now, one other thing I've realized, especially for some of the clients that I've engaged, is limited formal documentation of their financial reporting controls. So you realize that they are doing something, okay, they have a revenue recognition policy in practice, but they've not documented it anywhere. They probably don't have a financial manual. They probably don't have a warehousing manual. They don't have a formalized document that is supposed to guide day-to-day activities and identify the risk, identify controls. So yes, they are doing something in practice, but it has not been formalized. So you don't have a clear vision on which direction they are moving. Now, you realize that for some businesses, they have controls, all right. Probably the design is fine, but you realize that there's inadequate testing and monitoring of the effectiveness of the control. So you realize that they have a very beautiful framework in place, but how you are regularly checking to see that it is effective and that even the process owner understands what they are doing and they are doing it as and when they should becomes a problem. They probably don't have documentation to support that this is happening, even though in practice it is happening. Now, another thing that we've realized in the space is weak integration between risk management, internal audit, and the finance function. Realize that sometimes it's hard to tell. Some of the functions don't even know who is responsible for what. They are not coming together towards a particular objective. They are shifting blame. You ask a function who is responsible, say go to compliance, go to risk, go to internal audits. Nobody is really ready to own or even understand what role they play. Right. So I think that is one thing that ICoFR would seek to address, where we can come in collaboratively. Everybody has a clear understanding of their roles and designation, and then they can carry it effectively. Now, another thing is insufficient focus on IT controls and automated controls. Now, as we are moving into automation, it's imperative that we really look at the IT environment, because that is what impacts our automated controls. Most of the time, there's really not much focus on IT controls, access rights, and all those other controls that are supposed to be embedded in an application control or general IT control. I've had experiences where there's an ERP system in place, all right, but nothing is happening. It's there, but all the controls are still manual, because the controls that are supposed to be embedded in the application control or the general IT control is essentially not there. Now, I think those are the gaps that I've identified. Now, if we want to be futuristic, if we want to be proactive, if we want to see what a future ICoFR would look like, we want to encourage entities to adopt an integrated 𝗂𝗏 framework. I think Frank mentioned what the 𝗂𝗏 framework was when we're talking about the ICoFR process, where we are looking from the control environment down to monitoring. So you want to make sure you institutionalize it and use that to evaluate your entire control environment. Now, conducting regular risk assessment and identifying key reporting risks, because things are always changing. Standards are changing. One thing about ICoFR is you are always looking at your financial reporting standards. So if it's IFRS that you are using, those are the things that guide your day-to-day execution. When the standard changes, what happens? So you want to make sure that you are constantly reassessing your risk. You are constantly reassessing your processes in line with the ever-changing or moving standards. Now, another thing is for you to document and standardize key controls and processes. I think I mentioned that there are gaps in documentation. So now the focus will be to how to standardize these key controls and document them. Okay, so that even for the process owner on his day-to-day execution, he can refer to these documents to guide his execution. Okay, so when I start my day, what am I supposed to do? What are some of the processes from initiation down to completion? What are some of the risks I'm supposed to be aware or focused on? And what controls am I expected to implement? Once this is documented, it's easy for people to follow through and understand what is required of them. Now, another thing that would be useful is strengthening board and audit committee oversight. I think Hadi mentioned the part about board oversight. So if you're able to strengthen that, you realize that it would really bridge the gap. Now, we also want to invest in control testing, monitoring, and remediation. Sometimes when you engage with clients, they don't really see the value in testing controls or investing in some systems that can support with automation, or even a consultant to come and look at what they are doing and see how well their controls are working. It's something that they think is a peripheral thing. It's not really that key to the business, but you realize that in how things are moving, it becomes very essential that we invest in control testing, we invest in monitoring, we invest in remediation. We should have a monitoring team that has been set aside to do a monitoring, if it's on an ongoing basis or a separate evaluation. Anytime transactions are going on, people are there to ensure that the controls are working effectively. And if there are any deficiencies, they're able to communicate it to the right people. Now, I think one of the things that I'm passionate about when it comes to the ICoFR conversation is our mindset, and then also a cultural shift. Most of the time, people don't even appreciate what they are doing. One of the things that we are trying to encourage is for people to really appreciate what risks are, what controls are. It will guide how they do their work day to day. Sometimes you sit with the process owner, you ask them what a risk is and what a control is based on what they are doing, and they don't even understand. So it is high time we sit down and really critically look at what that means, what is the value it brings. Let them understand what they are doing, such that they'll be able to have that consciousness. They'll even be able to preempt risk before they materialize, because that consciousness or awareness exists. Yes, thank you.
Thank you very much for that submission, Priscilla. And it's given us a clear understanding of the level of segmentation when it comes to the maturity of ICoFR frameworks across different sectors within Ghana, and some experiences that you've had, even as to the understanding of what ICoFR is, what internal controls are, even to the level of process owners who are supposed to be implementing some of these controls. But we are moving back to Hadi, whose team has been doing ICoFR for quite some time. If I'm not mistaken, about 3 to 4 years of ICoFR in Ghana. Looking at the fact that your ICoFR was a push factor from the Nigerian requirement, even though you have made some steps on that, currently looking at the advantages that you have derived from this ICoFR process, how will you benchmark what your organization has gained from this process against an entity who does not have any structured ICoFR program as of now? Sorry, Hadi, please, your mic is off.
Can you hear me now?
Yes, please. I can hear you.
Thank you for that question, Prince. I think certainly yes. Naturally, my institution is a control-conscious organization that is not replete with audit issues. But implementing a structured ICoFR program has, if I would say, additionally made our external audit experience very smooth, because controls are documented and tested regularly. So it places you in a situation where you are always audit ready, just like a soldier who is always ready to shoot. And then again, the fact that the controls that underpin the preparation of our financial statements are reviewed and validated, by an independent party annually to see if the design is adequate enough to prevent or detect material misstatement, enhances the confidence with which investors and other stakeholders view our financial reports. Of course, someone can argue that even when external auditors review your books, they also express opinion on the adequacy and effectiveness of the internal control system. But you will agree with me that that opinion is usually based on the risk-based audit that they have conducted. But what ICoFR does is to benchmark your controls against the 17 principles of the COSO internal control integrated framework to see where you are actually ticking the boxes and where you are lacking. So yes, I think it gives us an edge over organization without a structured, ICoFR program. Thank you, Prince.
Okay. Yeah, thank you so much for that submission, Hadi. Yes, so the next one is to Frank and then Priscilla. We've talked about the fact that currently there is no consolidated ICoFR framework that governs that structure within Ghana. If mandatory ICoFR reporting were to be introduced in Ghana in the next few years, how prepared do you think organizations are today? And what would be the biggest challenges that they would face? Yeah. So Priscilla, please, you can take yours first, and then Frank will come in.
Yeah. So I think that if it does become a regulatory requirement, the preparedness or the readiness will be a mixed one, because for larger banks, insurance companies, the entities that are highly regulated, or some multinational organizations already have something like this in place, maybe not as structured or formalized like we are discussing, but they already have something of that nature in place. So they'll be relatively well positioned because they already operate under strict regulations and governance requirements, right? But for organizations that are outside of these heavily regulated sectors, it will still be an early stage of maturity, and so they would have to put in much more work in getting ready. Now, some of the challenges that I envision happening is, like I mentioned, the documentation of controls. Now, for entities that we've implemented ICoFR, you would realize that ICoFR takes a lot of work. It's a lot of time. It's time intensive. So you have to try and understand the entire ecosystem of the organization, try and get your risk assessment to identify the financial statement line items you want to focus on, and then document your controls or document the process end to end with the controls embedded. So you will see that many organizations have the controls in place, but like I mentioned earlier, they are not formally documented or mapped to the financial reporting risk. So you have to painstakingly take time to do that assessment, try and understand what you're doing, document it, map it, find the inherent risk, find the controls, and then do that in consolidation. So documentation of controls would be one of the major things that would be quite a challenge, especially for the non-regulated sectors. Now, control testing and monitoring is often limited. There's often limited experience in understanding or evaluating control design and operating effectiveness. People don't really have a good sense of appreciation when it comes to issues on control testing and monitoring. So you realize that you have to do a lot of training and capacity building to be able to support people to really appreciate and then carry it out. Now, resource and skill constraints, I think very similarly to what I said about control testing and monitoring, is about the specialization, okay? The ICoFR expertise, because it's a new and emerging thing that is happening in our landscape, people are still trying to learn and understand and appreciate. So you have to build them up, and then you have to also get the required skills to be able to execute. Now, like I mentioned, for my experience, you realize that sometimes accountability becomes a very big issue. People don't really know what they are supposed to do, or they keep shifting blame. So one of the things that I see happening is how to assess or determine who owns what. So clear ownership of ICoFR responsibilities by management, and also to have the board's buy-in and oversight. So that would need to be strengthened, right? Now, the cultural shift, I think I'm repeating myself, but it's still the same points I want to touch on. The cultural shift from moving from the compliance mindset, okay, they said it's a regulation, let's just tick the box, let's just put the right documents there for external auditors to come and view. That is not what we want. It's about value, because there's so much to gain from having the ICoFR implementation. It supports your business immensely. If you look at the rigorous process you have to go through from control environment down to monitoring, it's a lot of work, and you'd see a lot of issues that you probably ordinarily wouldn't have seen or identified if you had just done what you traditionally do. Right. So the cultural shift is very important. People need to really appreciate and understand that this is a very important part of the business, and it's going to inure to the organizational objectives. So that is what I would say on this point. Thank you.
Thank you, Priscilla, for that. So documentation of controls, control testing, clear ownership by management, and then the cultural shift are some of the key gaps that you see hindering the process when it comes to the implementation of ICoFR over the years for new organizations, if it is to become a mandatory item here in Ghana. Frank, the floor is yours.
Okay, thank you, Prince. So for me, I agree with Priscilla. I think organizations would start from different places when it comes to preparedness, because some regulated institutions and multinationals may already be used to the level of control and reporting required for ICoFR. For others there would be more work to do. And I think where it becomes challenging is that ICoFR is not something finance can implement on its own, because the controls that support financial reporting sits across the business. So you need people across those functions to understand what is expected of them and take responsibility for their part. And once you also bring in technology into it, especially where systems are doing more of the processing and some of the controls are automated, you also need people with the right skills to understand and assess that environment. So when you put all of that together, the time and people and resources required, you realize that they will all differ from one organization to another. And I think that will be an important consideration if an ICoFR requirement is actually introduced in the Ghanaian landscape.
Okay, that is well noted, Frank, for that. Just a follow-up to this question for Frank and then Priscilla. I think one concern that we hear a lot is how resource-intensive ICoFR can be, particularly for small and then less mature organizations. If such organizations want to build an effective and then proportionate ICoFR framework, which might not be demanding that level of resource intensity that maybe some big companies can bear the financial outlay, how do they go about strengthening their financial reporting without creating any unnecessary compliance burden for such institutions? Priscilla.
Okay. I think it's a very good question, because I have encountered this question quite a number of times during my interactions. They think it's quite intense in terms of the cost. The cost is cost intensive. Now, what I would say to that is ICoFR does not need to be that resource intensive if it is implemented using a risk-based approach and a proportionate approach. So based on the size of your organization, you can develop something that's or curate something that is best suited for your size of organization. But because we go with a risk-based approach, what it means is that we don't have to document every single process end to end. Okay, because I'm sure some people will be asking, how do I go about it? Because it seems like a very intense or detailed implementation. So usually we do a risk assessment because you want to identify the key risk areas to focus on. So it's usually a risk-based approach that you go through, and then you try and prioritize high risk areas. Maybe so for most entities, you look at your revenue process, you look at your procurement process, you look at your payroll or your cash or your bank, because those are the key processes that really drive the business and have very high risk. Okay, so that's what you would want to look at. Now, you also want to focus on key controls. I think maybe none of us has mentioned, but I'll just go ahead to mention that ICoFR focuses on financial reporting controls. So we are not necessarily focusing on operational controls. So your day-to-day operations is not really the focus. The focus is on the controls or the risk that impacts your financial numbers. Okay, so most of the time when you are documenting, your focus will be on financial reporting controls. So when you are prioritizing your high key areas and you are documenting, your focus will be on controls that impact the financial statement. So when it comes to risk, it's about risk on inputting, how things are keyed in, who is reviewing it in the system to ensure that postings are done right. Those are some of the thoughts you have to go through in identifying the risk and controls. Now, ICoFR doesn't also mean that you have to necessarily start putting together controls or conjoining controls. If you have the right controls, you can use that, you can standardize that, you can simplify that in your documentation. So it is not really about generating more controls, but it's about getting the right controls for the risks that you've identified. Now, in the spirit of automation, because I am very passionate about automation, technology can also support with where practical. I mean, of course, for some small businesses, depending on how cost intensive it will be, you'd have to make such considerations, but you can use technology to improve efficiency and also reduce the amount of manual effort. Now, I think Jeremiah mentioned something about phasing. So you want to have a phased implementation. So maybe your focus will be on key business processes. So you pick a few key ones and then gradually trickle it down. So that is how you can, manage the costs or the resource-intensive aspects of ICoFR? Thank you.
All right, thank you very much for that, Priscilla. Back to Jeremiah. Yes, so we are currently talking about the resource intensity of ICoFR, the myth around that. When it comes to Dover, the period that you have been in Nigeria implementing ICoFR for various companies across different sectors, when it comes to such implementations, where do organizations struggle the most to implement it effectively? And is the root cause typically around a weak control design and inadequate execution of the ICoFR framework itself, or leadership and then organizational culture issues? What patterns have you observed around this when it comes to the implementation of ICoFR within Nigeria?
Okay. Thank you, Prince, for that question. So I think the challenges could be multifaceted, but one thing that was prevalent, particularly at the start, was having the resources with the right skills to first identify those financial reporting risks, particularly when you have an organization with a lot of material accounts. Then you would agree with me that in implementing the ICoFR, there's some sort of business process mapping that has to be done, mapping those financial reporting risks to the relevant processes. So first is having the resources that can perform the initial risk assessment, and then the process mapping, the system mapping, identifying those the systems that are critical to the business. So you would have a mix of people with understanding of standards and financial control, and people that understand IT control, ITGC, ITAC. You can find that in maybe some unicorn professionals that have both skills, or sometimes you can find that dispersed across teams. Now, when you have multiple stakeholders that have to perform work like this, it means that you need to have that leadership to be able to drive the implementation. That's where leadership buy-in comes in. Maybe someone that has accountability for the ICFR implementation can sit within the office of maybe internal control or the CFO, whichever, but you need someone that's accountable to galvanize the team to drive the implementation. But we've also seen challenges around where controls exist, but businesses had poor visibility into where those controls sit and responsibility, and who has responsibility for those controls. So pulling all of that together to have a centralized first risk and control metrics that gives everybody visibility as to what exists within the business and the risks that they mitigate. You see that requires a lot of work, but also a lot of coordination that leadership has to drive. So for it to be successful, the implementation to be successful, you need to have the skills, the skill set within the business, or source that skill set somewhere else, like maybe outsource. And you need to have leadership buy-in to drive things, because you'll be interfacing with a lot of departments. Finance, for the ELC, that's your entity level controls. You have things around ethics. You will most likely be interfacing with human resource. You'll be interfacing with maybe the company secretary for things around what the board's posture is around oversight on financial controls. You will also be interfacing with risk management for those for the risk assessment, and their purview also all that over financial oversight over financial risk. So because of the sheer amount of number of people you have to interface with, you need that leadership buy-in and leadership inputs to drive things, and a point of focus, probably someone as a champion for you to drive it within your organization, and then documentation can then start from there. So those are typically the challenges, and you can as Priscilla has said, as Priscilla said, you need to adopt a phased approach, and that's why being proactive is even more important. Because what we found implementing was, because there was a deadline and it wasn't something that was prevalent at the time, everyone was scrambling to meet that deadline. But imagine a world where organizations were adopted a phased approach, identified material accounts, and identified the risk for those material accounts, and probably across over time started documenting, started mapping those risks, those systems. By the time there will be a regulation, you will most likely be ready. What you need to do is revalidate, check for where there have been significant changes within the business to update the risk and control. So it really helps to avoid some of these challenges, to be proactive. Thank you.
All right. Thank you so much for that, Jeremiah. So you have spoken about the fact that the root cause of this is not one or the other, it's multifaceted, and that these are the pivotal aspects of the success of an ICoFR implementation, that you need a very resourceful staff who understand what they are doing. You need the buy-in of the executive management, because you're going to be interacting with a lot of different people across the organization. And then again, you need an organizational culture that is ready to accept and then do what it must when it comes to the implementation of the controls that have been assigned to various process owners around that. Back to Hadi. Jeremiah has spoken about the fact that the implementation deadline when they first came in was a rushed one, so there were no first movers that were trying to gain some advantage of that. But in your case for Ghana, you've been doing it for a number of years, and you've seen the pitfalls and then the challenges that you've had in trying to get the whole system together as you are seeing today, which you might deem a bit more effective than when you started with. Looking back at that implementation journey, if an organization is to begin today with limited time and their resources, as we've spoken about the resource intensity of ICoFR, what are the first three things that you would encourage such an institution to focus on?
Well, thank you very much, Prince, once again. Well, if an organization intends to implement ICoFR program, but with limited time and resources, three areas I would encourage that organization to focus on that can actually provide the greatest reduction in financial reporting risk are: one, I think Priscilla mentioned it, that's to carry out risk assessment. And this is to enable you focus resources on what matters the most, because you want to know the financial, statement line items that are large enough to contain some material misstatement, and those particular FSLIs must form part of your risk assessment. So that is one. And then secondly, you should be able to implement and document the key controls that can address this risk that you have identified in one above. And then finally, you should be able to regularly test those controls and promptly remediate deficiencies identified. Because as we all know, our controls only add value if they are operating effectively and they are able to actually identify or prevent, they are able to detect or prevent material misstatement. Anything short of this, you will not have achieved the essence of that control. So this is what I will say.
Thank you so much for that, Hadi. So the big three that as an institution, no matter how big or small you are, you should focus on when it comes to the implementation of ICoFR is the first one being a risk assessment, as Hadi has said, because that's how you know which areas are quite material for you to focus your monitoring on or the testing on. And then again, the implementation and then documentation of risk within these areas that you have scoped in. And then finally, a regular testing of these controls and then the risks that you've identified within the scoped in areas that you have assessed through the risk assessment that you have done. Thank you for that submission, Hadi. Back to Frank. So we have seen that IT automated controls and then IT controls, application controls, and then general controls are a key part of the assessments that we do when it comes to ICoFR. And many organizations are investing heavily in ERP systems and then digital transformation with the advance of AI and what have you. How should organizations start thinking about automated controls and then IT general controls as part of their ICoFR journey? Where does it sit within that whole process of ICoFR when it comes to the framework that we set up for organizations? Thank you.
Right. Thank you, Prince. So for organizations, they need to look at technology through the same risk-based lens they applied to the rest of their ICoFR framework. So the organizations can look at starting by understanding which systems are important to financial reporting, how those systems support the process, and where you are relying on the system to perform a control. You also look at the risks within the system too as well, and from there you look at the automated controls that address the risks you have identified, whether that is an approval, calculation, or validation within the system. And once you are relying on the system to perform those controls, you also need to look at the environment around that system, looking at who has access, how changes are made, and how the system is managed. And that is where IT general controls come in, because they give you the basis for relying on the systems and automated controls supporting financial reporting. So as organizations invest more in ERP systems and digital transformation, both automated controls and IT general controls need to form part of how they think about ICoFR.
Yes, thank you for that, Frank. The next question is to Jeremiah, but as also somebody that is well versed in the CACM, as we noted, when it comes to the same aspect, the implementation of ERP, sometimes you go to an institution, then you realize there's an ERP in place, but then the expected automated controls or the general controls that you want to see within such systems are non-existent or not being used. They are going manual, even though there are structures in place within that system. In relation to the same question that Frank gave a submission to, do you have any other submission for the team as well?
All right. Thank you very much. So yes, it's not unusual to go to a business and find that they have systems in place that are not in use, or there is a disconnect between what is documented and practice. Typically, and this is where ICFR actually adds value, where you management, because of the level of disclosure that's required, actually drive initiatives to align policies and practice. We've had cases where you'd have trainings, particularly in cases where maybe a control is not operating effectively because of human causes. You'd have trainings to ensure that people adopt formalized controls, because you have controls documented in your policies and procedures. They adopt those formalized controls and operate controls as they are supposed to be operated. We also have cases where systems rather have been implemented, but policy lags, or controls that have been formalized in policies lag those systems that have been implemented. The periodic assessment of internal control over financial reporting allows you to actually align that, because once you've done the initial risk assessment, you've mapped to systems, and then you find that the systems where these transactions are carried out don't have the necessary controls to prevent or detect material misstatements. That becomes an ethos for the board, for senior management, to actually redesign or enhance controls such that they align with the reality of the business and they actually prevent those risks. So that's typically one of the opportunities, or one of the benefits rather, of ICFR, because it brings those gaps to light, and then management and the board rally around that to then be able to remediate that.
Thank you for that. So in relation to that as well, for ICoFR, we know that the Chief Finance Officer sits at the center of the financial reporting process. Beyond regulatory compliance, what are some of the practical implications that the CFO will face when it comes to having weakness within the internal controls over financial reporting framework that their organization has implemented.
Okay, thank you. First, I would answer from a regulatory perspective. If you have weak internal controls, the regulation is clear. There are three categories. There are material weaknesses, significant deficiencies, and deficiencies. If you have those, you have to disclose. In fact, I had mentioned the Provision 9 of the UK that becomes effective from 1st of January. It goes even beyond financial control to say if you have material weaknesses, you have to disclose and also highlight remediation plan that will be tracked periodically, because the next year you're coming back to say this is how we've effected those action plans. So because of the level of the regulatory requirements, CFOs definitely would have to disclose where their material weaknesses. But beyond that, if you have material weaknesses within your processes, if you have weak controls, it then means that you would have to draw up a plan to be able to remediate that. Because at the start, as a CFO, you want a system of controls that allows you to trust the data and the financial decisions that the data that you utilize in making financial decisions. But ICFR has changed the landscape such that you're not waiting to some later time in the future to remediate. If you want investors to have confidence in the data you're putting out there, your financial reports, it means you have to either remediate that by redesigning processes, by implementing new systems, or disclose to stakeholders. So organizations have to choose which they want to do, and I think I know what organizations will choose. Most organizations would actually want to remediate so that they strengthen their internal control over financial reporting.
Thank you so much for that response. That's an insightful response from you, Jeremiah. We're moving on to Hadi. When it comes to accountability, we know that for the space of time that you've implemented ICoFR, the finance department and the internal control functions work together very closely to ensure that the ICoFR process is a success. For your organization, Zenith Bank, where has that collaboration added the greatest value when it comes to the interaction between finance and the internal control in executing ICoFR?
Thank you very much, Prince. I think finance and control work together actually throughout the ICoFR program across various processes. At risk assessment phase, finance will actually identify significant accounts, processes, and financial reporting risk, whereas control will actually challenge those assumptions, evaluate the control risk, and then align them with regulatory expectations. And then across process and control design, finance will also come in and then document the business processes and perform the controls. Control will come in to review the control design, identify the gaps, and then recommend improvement. And then at control execution level, finance will also come in again, perform the key controls and maintain evidence. And then control will now monitor execution quality and provide guidance. Across testing phase, yes, finance is still there because they will provide documentation and explain the transactions, whereas control will also perform or coordinate testing and then evaluate the effectiveness. When it comes to deficiency assessment, we still have a very good collaboration there because finance will actually explain business impact and the root cause. Okay, and then we have control coming in there to assess the severity against the ICoFR criteria. When we come to remediation, finance will still be there because they will implement the corrective actions, whereas control will validate the remediation design and its effectiveness. When it comes to external audit support, finance usually will coordinate the evidence and the management responses, when control will actually be testing the approaches and then support the audit discussion. But in all of this, The greatest value from the collaboration typically comes from the area of risk assessment and scoping, because finance understands where financial reporting risk originates by underlying FSLIs that are large enough to contain material misstatements for risk assessment. Internal control, on the other hand, understands regulatory expectations and control, frameworks. So together, they identify the controls that really matter, avoiding both over control and under control. Because you don't want a situation where you overly control to the extent that your controls are not beginning to militate against business. So that collaboration is always key. And that is the extent of the collaboration between control and then finance. And then even if you look at how that framework, internal control over financial, reporting has been coined, you see control on one part, and you ask yourself, which department is primarily responsible for implementing control or designing control? It's internal control. And which department is responsible for preparation of the financial report? It is financial, control. That's how come we have the framework. I don't think that they made a mistake in coining the framework, internal control over financial reporting. Thank you, Prince.
Thank you very much for that, Hadi. The next one is to Priscilla. In relation to this same segregation of duties item, we know that internal control, internal audit, and then external audit, they each play distinct roles when it comes to the ICoFR program. Yet sometimes the responsibilities are misunderstood. How should organizations clearly define these roles for these particular departments? And how can internal audit specifically provide some meaningful assurance without compromising its independence within the ICoFR framework that we have?
Okay, thank you, Prince. So a successful ICoFR program requires a clear understanding of the 3 lines of responsibility. So here, like your question mentioned, we have the internal control function, we have the internal audit function, and we have the external audit function. We know that management owns and operates the internal control framework, like Hadi mentioned. So it's management's responsibility to institute controls or put controls in place. Now, we know that internal audits is on the 3rd line of defense, where it independently evaluates and provides assurance on control effectiveness. In fact, their responsibility is to the board. So they are supposed to report on or give assurance on how well the controls are effective to the board. So internal audit's responsibility is solely to provide assurance. Now, for the external audits role, what they come and do, like I mentioned earlier, is an attestation. So they come and assess the certification that has been done by the CFO or the CEO or management collectively, and then express an opinion as to the reliability of the controls in place. Now, what we want to make sure is that we don't overlap these responsibilities. So internal audit's function is not to design or implement controls. Neither is external audit's responsibility to do same. They are both assurance partners, where the internal audit team focuses on providing assurance to the board, and then the external audit team comes to do their statutory review and also try and validate or attest to what the CFO or the CEO is saying. So it's very imperative that those roles are not overlapped and people understand or have a good appreciation of their responsibility. Thank you.
Thank you very much for that, Priscilla. With that, we are gradually bringing the show to an end. And for our last question, we will have Jeremiah take us through that. And from the backdrop of how far they've come with ICoFR within the Nigerian space, Jeremiah, looking back on Nigeria's experience, what has been the biggest lessons from implementing mandatory ICoFR reporting that other markets, including the Ghanaian market, should take note of? Yeah. Thank you.
Thank you very much, Prince. I think the first thing is that your statutory audit, the financial audit, it's not the only picture, particularly for investors and regulators. We've had cases from our own experience where the numbers are not necessarily materially misstated, but the risk exists that they could have been materially misstated because of the deficiencies that existed within business. And if the regulation was not enacted, could have had cases where that risk could have crystallized, overstatement of revenue or understatement of liability, and investors would have made decision based on that. That's one. So we should not conflict both the statutory audit and then the internal control of financial reporting, even though they all feed into the financial statement. So that kind of creates a impetus for internal control of financial reporting. But beyond that is the sheer level of visibility that stakeholders across the business, particularly the CFO and senior management, the sheer level of visibility that they have into the effectiveness of the internal controls that they have in place and how they are able to make decisions quickly to strengthen, to rationalize those controls, and the level of confidence they have in the decisions that they're now making with their numbers. So that's the second thing, the value that it brings to management, even when they make decisions. I think that's what I have seen. I think lastly, another thing I would add is how transformational it has been for some businesses, particularly around redesign, system implementation, mapping out those controls that you need to have within your system to ensure that the risk of fraud is mitigated, and also having that board oversight to ensure that management override of control is also properly mitigated. So those tiers or level of accountability within the business too had to be strengthened because you need to disclose that. And I think that's something that will be relevant to Ghanaian business and the financial markets generally within Ghana. Thank you.
Thank you very much for that insightful comment, Jeremiah. Too soon we are bringing the session to an end. We want to quickly take on some few questions as we try to wrap up. Yes, so there's one question within the chat box that is addressed to Priscilla. Yes, and it's how different the other. I asked because through programs or assessment and reporting of internal activities in all areas, including financial reporting. All of these provide the board, audit committees, regulators, stakeholders, and shareholders with some form of assurance of the internal control environment. So, Priscilla, you can take the question.
Okay, I think you were breaking up, but I was able to read the question. So I would say that while other internal control programs provide assurance across all areas, ICoFR is uniquely tailored to focus specifically on controls that directly impact the financial statement accuracy. I think we've mentioned that a number of times. So the published accounts that you see on a day-to-day basis, what are the structures behind those figures that are being churned out? That is where the focus is. So it's about the reliability of the financial statements as well as the financial reporting process. So that's the difference. So another thing is that you realize that on the traditional way of reviewing controls, you are looking at operational controls, you're looking at compliance across all jurisdictions, whether it's with your taxpayers, whether it is with your regulator, whether all of those concerns are being addressed with the traditional way. But with the financial ICoFR as a financial reporting system, the focus is on financial reporting controls, and it also leverages globally recognized the COSO framework that we're speaking about, and it's also structured to meet auditor and regulatory expectations. So in addition to just what you're doing on a day-to-day basis, you are trying to meet what the regulator is asking for. So this is a uniquely tailored or uniquely designed framework. And of course, it's also supposed to impact the reliability of your numbers. So it's quite targeted, and the assurance is on the financial reporting process rather than the general operational compliance. Thank you.
Thank you very much for that comment. I hope whoever dropped the comment in the chat box has received the response that they were requesting for. Yes, so at this juncture, okay, Jeremiah wants to speak as well on that. So Jeremiah, please, you can go.
Yeah, thank you. Just to add to that, I think one key difference is the level of accountability that it enforces when it's a regulation. You would agree with me that various organizations have different level of maturity when it comes to implementing an internal control framework. And because of the disparate focuses on compliance, operations, and finance, they might not go into detail into material accounts to actually perform those reviews. But because there's this regulatory requirement, you now have focus, narrow in on finance, and then provide that the disclosure that's also required kind of forces organizations, mandates organizations to do that periodically and provide that disclosure to stakeholders. So that's the key difference, the level of disclosure and transparency that's required. Yeah.
Thank you very much for that submission as well, Jeremiah. And for this entire session, you met 4 panelists, 3 from KPMG, 2 KPMG in Ghana, 1 from KPMG in Nigeria. That alone should tell you that we have had some level of understanding when it comes to ICoFR. And when it comes to how we can help you in relation to ICoFR, we have Priscilla to take us through that. Priscilla, please, you have the floor.
Yes. Please, can you move the slide? Now, I mean, we've had a very, very in-depth conversation on ICoFR, right? So maybe we just want to take the conversation forward to say, how do we support you if you are really considering the implementation of ICoFR? So we have the ICoFR assessment, the ICoFR compliance, ICoFR training services, and we also have ICoFR quality assurance. So for the ICoFR assessment, what we typically do is a risk assessment and a gap analysis. So like we've been mentioning, I'm sure some of the words sound like jargon, so I'll try and break them down so we understand. So when we say risk assessment, what we are basically saying is, because it's a risk-based approach, we typically try and identify inherent risks, do some risk considerations, and determine which of the financial statement line items you want to focus on. So on your financial statements, whether you have your balance sheet or your P&L, the lines you see on the face of the financial statement is what we refer to as the financial statement line items. So you can have for your balance sheet, your PPE, your cash and cash equivalents, your receivables, your payables. Those are what you see on the face of that statement. So those was what we refer to. So that's the subject of our consideration. So those are the things we run through, some risk considerations to be able to zero in on the areas we want to focus on. So we do that risk assessment for you. And also we look at your entity level controls, which are your overarching controls or your controls that are not tied to a specific process. Okay, so when you take something like your code of conduct, it's across the entire organization. So those are some of the structures we want to focus on and do a gap analysis where we assess it against the 𝗂𝗄 principles. So we have 17 principles of the 𝗂𝗄 framework. So it's in questions. So we ask specific questions, get the responses from you, and get the evidences to support the responses. If we realize there are gaps, we do a gap detection, and then we give you remediation plans for it. So that's what we do. We also do the process documentation, where we focus on the risk and control matrix documents. So that is what we've been talking about all this while. The entire Bible of ICoFR is the RCM document. That is where you evaluate the FSLIs across the 5 pillars of the 𝗂𝗄 framework. So from control environment down to monitoring, we do that. So if you pick revenue, for instance, we identify the inherent risk in revenue. We identify the controls that address the risk in revenue, and then we run it through all the pillars of the COSO framework. So that assessment is done. It's typically a very intense document. It's quite comprehensive and quite elaborate. It's quite a lengthy document. So it's quite an amount of work that we put into that, just to make sure that we've been able to identify all the controls, all the risks, all the way down to monitoring. So we do some testing. We evaluate the design of the controls that you have to make sure that they are fit for purpose. So when I say fit for purpose, what I mean is that the design has been put in such a way that it can mitigate the risk that has been identified. So that's what the design is for. And also we look at the operating effectiveness of the control. So outside what the design looks like, how well is it being implemented? Is the person who is supposed to do the work doing it as they should? If the frequency is such that they do it on a daily basis, are they really doing it on a daily basis? So that's what we look at with the ICoFR assessment. So the ICoFR compliance, we just want to make sure that you are ready for the regulation. So we just make sure that you are ready for the regulation. So where we look at your SOX compliance, implementation of SOX. So if it's a SOX that we are looking at instead of ICoFR, we look at that, and then training on compliance. So capacity building and things that have to do with being ready for the regulation. Then we also have trainings as a standalone service that we offer, where we share fundamentals on ICoFR. We look at regulatory compliance, we look at control design and evaluation. So in essence, the training is to equip you to do the implementation yourself. Now, there's also the quality assurance bit, where you do it on your own. We come and give you an independent assessment as to whether you've done it well and whether it meets the industry standard or the international standard. So those are some of the things we can do to support you on your ICoFR journey. Thank you.
Thank you very much for that, Priscilla. And that is what KPMG does. So if you would want to reach out to us, we have the QR code, and we're also dropping the link within the chat box. You can reach out to us through these means, and then we will contact you as and when. Again, if you would want to speak to the leadership of the team that is in charge of ICoFR for KPMG in Ghana, we also have that team, which is made up of our partner, that's 𝗥𝗲𝗹𝗶𝗶𝗶. We have Associate Director 𝗕𝗂𝗏𝗏, and then �priscilla Phiosah, who we had on the call for today. As part of the webinar sessions that we've been having, there are a few others that are on the way within next month and then the month to come. We have the IFRS S1 and then S2 sustainability reporting. That is to come off on the 5th and then 6th of August. It is paid training, and you can contact the key persons that we have on the flyer if you would want to partake in this training. We also have a free webinar that's coming up. That's on create value through combined assurance, enhancing collaboration and organizational resilience. We've spoken a bit about the role of internal control, internal audit, and external audit within the ICoFR framework to understand how all of these second line and then third line entities or departments work together to ensure that there is a robust risk management framework for an entity. Join us for this session as well. We also have another one coming up, which is on budgeting and planning essentials. And that is also a paid training that you would not want to miss. And once again, the QR code is ready. If you did not get the QR code, you can check the link within the chat box as well to get that link for you to interact with us there. Yes, so we want to thank the team that has been with us, our panelists, Priscilla, Frank, Jeremiah, Hadi. It's been an insightful session, and we know that with time, when we do get back to any other such webinars, we will be looking forward to having your faces on there to give some of these experiences on how far we've come when it comes to making ICoFR something that is very crucial and very core in the Ghanaian framework. To bring this session to a close, I would like to say that as organizations are increasingly navigating complex regulatory, financial, and then operational environments, the reliability of financials has never been more important. Strong internal controls of financial reporting is not merely a compliance requirement. It is a strategic enabler of confidence, transparency, and then informed decision-making. By embedding effective controls throughout your financial reporting process, organizations can strengthen governance, mitigate risk, and then enhance stakeholder trust. The true control advantage that we are speaking about today lies in building a financial reporting framework that stakeholders can rely on today and into the future as well. So we'd like to thank you for joining us, and we look forward to supporting you on your journey towards stronger controls and more reliable financial reporting frameworks. Thank you and have a good afternoon. Bye-bye.
Thank you, Prince.